Here's Alok Sam of Baer Capital, though, with his thoughts on the market. Alok, good morning. The market's been fed on a diet of very strong flows. Do you think all this talk in the environment about QE will lead to any disruption, or are we okay with liquidity for now?
Yeah, what's happening with respect to monetary policy, particularly U.S. monetary policy, is fairly fundamental to equity markets, actually fairly fundamental to all markets. It is sort of the mother of all monetary experiments never been done, and hitherto people have been talking about exit, in other words, the Fed reversing course in a matter of a few years. Of late, it is, thanks to some fairly robust data coming out of the U.S., people are now talking about this in terms of months. Now, just to get specific, the Fed is being quite clear that they are focused on the U.S. employment picture more than anything else, that they're actually focused on the unemployment numbers. And the view seems to be that it would take an absolute minimum of 3 months of very solid gains, improvements in the unemployment picture for the Fed to contemplate reversing course. At least change the pace of quantitative easing and gradually remove it altogether. So the earliest one could contemplate, if you think in terms of 3 months of solid data, would be the September-October time frame. More realistically, we're talking about next year. And and even thinking in those terms has fundamentally altered your average traders, whether you're a hedge fund or a long-term investor, you've used the markets, because this has sort of been back of your mind. Now it's very much front of mind, and it's been a big driver of the risk-on trade. And you've seen people take a much more cautious view of markets. It's now become a case of, can the fundamentals grow into the current valuations? And I believe they can, because the picture, at least in the U.S., is fairly solid. But this has implications for global markets, including India. I mean, you cannot rely on global liquidity and the risk on trade driven by liquidity continuing into the next 2 to 3 years. One needs to go back and focus on fundamentals. And I hate to use the expression, but we're back to this notion of coupling, decoupling. And individual market sectors and even companies, kind of the valuations based on fundamentals, as it should be, frankly, getting beyond the distortions that have been caused by complete unprecedented degree of liquidity that's been created by the central banks.
Alok, morning. We've also got GDP figures due today. What do you expect to see from that performance, and how are you feeling generally about the Indian macros and how they've been shaping up?
So India macro is, with India over the last 2 years in particular, it's been a stagflation-like scenario. You've had, on the one hand, a growth recession. You've had GDP growth that's moved from a 8-9% per annum trajectory to more 5-6%. And on the other hand, you've had inflation, CPI inflation at 9%. We see a gradual reversal in that. So in other words, growth 2013 might be 2012-13 might be 5. We probably see a gradual improvement in that to say 6% in the current fiscal year. Likewise, inflation going from 9 to more in the area of 6. So complete reversal of that. In other words, GDP growth accelerating, or GDP accelerating, and inflation coming down, and that in turn has the corollary of the RBI having a little more leeway to reduce rates. So we expect rates to come down, policy rates to come down by a minimum of 50 basis points in the current fiscal year. I think there's been an improvement in the fiscal picture, given a cutback in expenditures and other steps the government has taken. There's an improvement in the current account deficit, and the price of commodities, oil and gold in particular, in terms of prices coming down, that has helped the current account deficit picture. So you put all that together, and the macro outlook for India is certainly an improving one, and that is a backdrop in terms of thinking about the Indian markets.
So what's your view on the market in India post the recent consolidation that we've had? Do you think it's the macros which will continue to lead market performance?
So again, going back to the macro outlook, we are constructive on Indian macro, and by extension, we are constructive on the markets. So we do think that that while there's been a pullback, that it's reasonable to expect a sort of a 15% type upside in the markets in the next say 6 to 9 months. And that's a function of, once again, an improving macro outlook and assumes that the global liquidity picture stays stable. We don't expect any sort of tail risk type outcomes that one was so fixated on in terms of an implosion in Europe, etc. One doesn't expect that. The main headwinds one faces in India are frankly politics more than anything else. I mean, I think there's an acceptance that India is condemned, if I may use that expression, to an era of unstable coalition politics in the foreseeable future, and I'm talking about the next 4 to 5 years. The only question is will the next government be an even more unstable coalition than the current one? There's some outcomes around that, extreme outcomes around that could really rock the boat. But our base case is the market is reasonably valued. We think earnings have hit a trough, bottom out in terms of the growth outlook is reasonable in the context of an improving macro outlook, and that causes us to be constructive on India.
What's disconcerting though, Alok, is the way the rupee is moving. Lowest close since July last year. What have you made of this kind of continued weakness we've seen on our currency?
Yeah, I think what's happened with the rupee of late has been more a function of dollar strength. I think people's fixation on a QE reversal and the natural implication of that would be a stronger US dollar. So people have positioned themselves in a fairly bullish fashion with respect to the US dollar across the board. And that's hurt the rupee. I think it's been much more that as opposed to any India-specific factors. So our base case is an improving, solid flows into the equity markets. So on capital account, you've got solid inflows and an improving current account deficit picture, which is driven by lower commodity prices more than anything else. And if you put that together, we are, rupee around sort of, 54, 55 is probably reasonable, maybe even down to 50 if things continue to improve at an even better pace in India. I think things are possibly a little bit overdone. I'm not saying it couldn't get to 57, 58, but to me, at least to my mind, that's a bit of an overshoot.